before we get into the panel discussion and some Q&A, Bob is going to just give us some perspective on the historical multifamily market and maybe some thoughts on the statistics, what we've seen throughout the first half of the year, and what we expect to see over the second half of the year. So, ladies and gentlemen, Bob Knakal.
Thanks, Hags. Good morning, everyone. Today, what we're going to talk about is the rent regulation reforms, how they're impacting the multifamily sector, how they are going to impact stakeholders in the process. Those stakeholders include politicians, they include rent-stabilized residents, tenants, they include fair market tenants, they include property owners, they include the housing stock itself. So today we have a great panel that we're going to go into these issues with. Mitch is going to give us an overview of what the changes to rent regulation have been, how those changes are going to impact the market. Joe is going to talk about how banks are looking at the multifamily sector today, how things may have changed based on the changes that have happened to reform. Jeff is going to talk about institutional capital and how institutional capital looks at rent-regulated properties today and the multifamily sector in general. And Jay is going to talk about what the industry is doing to try to change things. There's a lawsuit that you may have read about that Jay is going to go into. But there are a number of things that we're going to talk about today, try to look at this issue from a balanced position. And as Mitch will tell you, the news is not all bad. There are some things that can be done to try to enhance value. But I thought what I'd do is just give a quick overview of how the market has been reacting to the potential change and now the actual change. And there have been very few data points subsequent to the new laws coming out. So we're still in price discovery mode relative to how these changes are going to impact value. But from a volume perspective, we've already seen some changes in the market. So let's take a look at what's happened with number of transactions. This is the multifamily sector for investment sales over $10 million. We see that we had a peak in 2015 at 136 transactions. We're down 38%. If you annualize what happened in the first half of this year, we are down 38% from last year's total and down about 66% from the peak. If we look at the walk-up sector, this has been more negatively impacted, mainly because there is generally a higher percentage of rent-regulated units in walk-up buildings than there are in elevator buildings. So this market has been more negatively impacted, 76%. As you see in the elevator sector, it's down only 43% as opposed to that 63. Dollar volume, the numbers are off very significantly, and my good friend Ofer Yerdani will always chastise me when I put this graph up there, because he'll say, but Bob, in 2015, Stuytown sold, that was over $5 billion. It's an 82% drop in dollar volume based upon what has actually traded. However, even if you take the Stuytown transaction out, it's still a 68% drop in dollar volume. The walk-up sector, you see an 88% drop in what is anticipated. And in the elevator sector, again, if we change the allocation and take Stuytown out, you still have a significant drop. Next two charts are very interesting, and we need to do more research on this. Our research department at JLL is fantastic. We have so much granular data on the market. These numbers just came out. We're showing that the average price per square foot amongst all multifamily buildings in the first half of 19 was $878 a foot. That is surprisingly high, particularly based on the next chart, which shows that the average cap rate so far this year has gone up to almost 5.5% in Manhattan. This is Manhattan south of 96th Street on the east side, south of 110 on the west side. So we're going to scrub these numbers, look into them a little more. That's very surprising that we can have such an increase in cap rate and an increase in price per square foot. That probably has something to do with the very low supply of sales that are in the statistical sample and what that sample makes up. So in looking at this, we need to figure out where the market is going. I would say that probably even with those significant reductions in volume that we've seen in the first half of the year, many of the closings that occurred in the first half were based on contracts that were signed before the November elections and based on contracts that were signed before the policies have been made public. There's been so much talk about what was going to happen leading up to June. But even in the first quarter of the year, there wasn't a lot written or discussed about it. So I think that probably the numbers may be a little overstated, and it wouldn't be surprising to see that volume is reduced further in the second half of the year. When the market shifts, whenever there's downward pressure exerted on value, what typically happens is that volume slows down, because sellers, if they could have gotten more yesterday than they can get today, they don't capitulate. It takes a while for them to become used to the new normal within the marketplace. And so anytime there's downward pressure on pricing, we see a drop in volume, and that's exactly what we've seen here. So with that being said, I'd like to turn it over to Hags, who's going to introduce Mitch to give us an overview of what's happened with the changes to rent regulation.